And that means we are live here on YouTube, Tackle Trading's halftime report. We got a full crew here today as well, like we always do. Coach Mark, Coach Noah, Coach Matt, Cody on the back end, and I am here as well, Tim Justice. Welcome out to our Team Tackle members. Let's break this market down. Let's actually start just with Noah here. Noah, I got you on screen share. Obviously, a very historic market condition here in March, the big precipitous sell-off, and now we've had 3 days of a bounce here, Noah. Run me through the chart before we get into the news here. A lot of news as well, but run me through the chart if you can.
Well, again, 3 days of a rally. I think noteworthy things are where we've seen it take out previous highs and establish some higher lows. And again, if we look at that on an intraday chart, you'll see a little trend reversal. I also noticed the average volume's been dropping back off. So we've had really high above average volume during the entire sell-off. And now that we're getting a little bit of a rally, so far we're seeing it taper a little bit. And again, it's early in the session now, but that's important to note because this has made a dramatic price move up. And again, it's on partial volume for the session. So I wouldn't be surprised if we saw another sell-off at the end of the day, like we did yesterday. If I were to break that down into here's a 1 hour chart, you can see an inverted head and shoulders reversal pattern, some higher lows and a breakout here at the 2560 zone. Right there on the S&P. So, it is slowing down intraday as you see the price move early at the open for the first couple of hours of trading. You're seeing the tops of those candles get a little bit closer together. If I were to drop that down into a 15-minute chart, there you see a little bit of slowing action where, big momentum right at the open and a couple of smaller runs here. And it's going to see if it can take out that 2587 here or not.
From bottom to top here in the last 3 days, the Dow has made 20% in gains, Mark, from the very, very tippy tip bottom to where we are right now. Just incredible ranges in the volatility. Just before we get into the news and whatnot, Mark, what's your read on the price action, just the nature of these ranges, the movement, just the velocity of how fast things are going right now?
Well, I mean, everything's faster. Up, downs, everything is faster. And so the headlines can be dramatic, right? S&P moves, these insane numbers, goes down, up, these insane numbers. And so you have to put it in a relative perspective. Like if this was normal price action in a normal, even in every downward trend, you have up days. In every upward trend, you have down days. Everything is just exacerbated right now. And so the moves, because you don't have these solid support resistance levels. You don't have, because gaps between moving averages are massive. You just have to try to suspend reality on the moves and put it in perspective of you're just dealing with normal price action that's just times 5, times 6. And so the numbers seem big and they can give hope or they can create fear, right? Markets down 10%, markets up 10% in these short time frames. And because the numbers are so massive, it can create an illusion on both sides. Just realize, I mean, this is one of the reasons day trading's so good right now, right? Because the moves are so big, you have these multi-week moves in the matter of hours. And I mean, that's why day trading is dominating right now. But in trying to analyze the big picture, just realize that these huge moves, you can probably expect them for some time now.
Go back into that intraday chart for just 1 minute here, Noah, because I think the timeline even from yesterday till today is really, really interesting to think through. Yesterday in the halftime report, Matt, we were looking at a potential breakout and then it did break out and then it started to move a little bit to the upside. Right at the end of the day, you had sharp selling into the close, and you had the volume pick up and the volume came in and the sellers showed up and then boom, through the overnight session, we came all the way back down to 2,400. So as the markets are moving up and down and then boom, right at 6:30 our time, which is 8:30 Eastern, that's when the volume picked up. But the international markets weren't buying into this rally. And really, we did start this right on an unemployment report. Matt, what's your read on the volatility and the price action here intraday, just the last couple of days?
Honestly, I get people out there being like, oh my goodness, the market's moving big time today. And yet we're underneath the average ATR range. So this is a very normal day in this market. The ATR on the S&P 500 on a daily basis moves about 219 points from, you know, the low of the market to the top of the market so far today, we're about 180 points. So we're still underneath the average actual performance in the market, whether it's up or down over the course of the last 14 days. So to me, this, you know, I see people out there being like, you know, oh my goodness, the market is just driving. I'm like, oh, well, it's kind of just a below average day so far. So it's par for the course. I don't think anybody should read too much into the market's price movement at this point, especially given the fact that we don't have the volume to really kind of support it. But what was interesting on the initial claims, Tim, and that's what everybody is talking about today, the initial claims came in at 3.28 million initial claims, which is by far a record number in the U.S. economy. The previous record was in October of 1982 when he had 695,000 initial claims. And that 3.25 million initial claims, to me, that doesn't even really tell the story of the initial claims. The expectation last week was going to be about 750,000. They revised that coming into the report a couple of days ago to about 1.64 million initial claims, and it came in at 3.28 million. So anybody who says the initial claims was baked into the market is flat out lying. Number one, they are flat out lying, because that number is a big time number. But I also don't believe the initial claims represents the truth of what's happening in the labor market right now. What about gig economy workers? What about part-time, low salary? What about contractors? And not only that, but what about the difficulty last week that it was to even file an initial claim? Which there were reports from many states that it was very difficult because they had a record surge in initial claims. And I believe the initial claims number, this is not the pinnacle of the initial claims. We're going to see the labor market get really beat up here. But it was fascinating. If you'll go back down to that, if you go to a 1 minute chart real quick here, Noah, what's fascinating in this marketplace over the course of the last really 2 weeks is it doesn't take a lot to spark a massive movement. When you're looking at that number at 6:30 in the morning, guys, nobody sold that initial claims order. Nobody did. Like, it literally just started going up, and it didn't have a lot of volume behind the movement initially. But once you start to see that movement come either up or down, that market just really kind of starts to drive and goes in line with that. And the same thing can be said about last night's sell-off. You know, the last 20 minutes of the market yesterday. You know, if you'll kind of back it out to a 5 minute chart, kind of look at the close from yesterday, there was a report that Bernie Sanders was not going to support the stimulus bill, and that sparked a sell-off of 100 points over like literally a 15-minute period. So my point is, it doesn't take a lot to get this market moving one way or the other in the very short term. And once the market finds that intraday trend, those algorithms just continually support that intraday trend until another news kind of comes out and hits the market, whether it's positive or negative. But what was absolutely fascinating this morning is the unprecedented level of effort that Wall Street and the government put forth in the same time period that the initial claims report came out. At the same time period the initial claims report came out, Jerome Powell is giving an interview on NBC where he's talking about, yes, we're in a recession, but the Fed is going to support whatever happens. The Fed's got the markets back. We have unlimited bullets, so on and so forth. Treasury Secretary Mnuchin is coming out around the same time period saying, yes, the initial claims is really bad, but everybody should discount it because this is going to be a short-term problem. The economy is still going to get back on track, and all of these people that have been laid off over the course of the last week and over the course of the next month, they're all going to come right back into the labor market once this situation kind of gets into the rearview mirror to a certain extent. Paul Tudor Jones, hedge fund fame, comes out on CNBC talking about this is a buying opportunity. And then Bill Ackman, who last week, Bill Ackman says, basically Chicken Little running for the hills, pleading with the entire world to social distance because he doesn't want to see his father die. And then all of a sudden, a week later, he's like, yeah, let's reopen the entire market. I'm going to remove my hedge. I'm going to remove my $2.7 billion hedge, and I'm gonna start buying stock with it. It was an unprecedented level of manipulation to a certain extent, and it really did remind me. And I've told this story before, and I'll be quick with it, but it did remind me of when Ben Bernanke in February of 2008. And if you'll back this out to a weekly time period here, Noah, the market was showing initial volatility to the downside. We had just double top, double bottom. The market's down about 15, 16% at that time period. And Ben Bernanke comes out in an interview and he basically states that there is nothing to see here. The subprime market is doing well. The automobile sector is doing well. This is just a short-term situation and literally nothing to see here. And in February of 2008, if you kind of put your crosshair there, you did see that little bit of a rally that kind of came back up into that 1400 level on the S&P 500. And then a month later, Bear Stearns goes out of business. 6 months later, we all know what happened in the subprime meltdown. I think it's a little bit foolish for Main Street America to make their investment thesis based on the opinions of people who have an incentive for you to buy something.
Mm-hmm. Yeah. I mean, Bill Ackman is, the flip-flop in the last 2 weeks is telling about what Wall Street is doing right now, Matt. I mean, he bet big against the market early on in this whole thing. He over-hedged.
He got a call from somebody somewhere.
He turned an $8 billion profit this month, and much of that was on put options that he held, and they just cashed in. So now he's talking about how everything's going to be fine, Mark. Jerome Powell coming out the exact moment. They scheduled his speech the exact moment the unemployment claims were going to come out.
If you believe anything Bill Ackman ever says again, then you are a fool.
Yeah.
Here's the thing. I mean, you've got to do your own thinking out there. There's no question about it. We all have to kind of think critically about what we're seeing in the data and the numbers, the information in front of us. When we're watching the intraday markets, obviously day trading is very important. But we're talking about today, Matt, a record 3.3 million unemployment claims and the market's rallying 4.5%. Mark, explain it. I mean, I know you and I and Matt, we've been sitting here all morning trying to wrap our heads around it as to what's going on.
And I want to get Mark's take on this because the only argument that I can see is this. Number one, the Fed has the markets back with unlimited bullets, and the opinion that this third stimulus, phase 3 of this stimulus plan, is not the last part of the stimulus. We've talked about that in the past. There's going to be more stimulus coming down the road. There's going to be more Fed actions coming down the road. So, Mark, the only thing I can understand, maybe an argument, is there was a time not long ago, a few years ago, where there was just terrible economic data, nothing like we're seeing today, but really, really nasty economic data. People were thinking, including myself, thinking we were staring down the barrel of a recession. And every time we saw negative data, the market went up because it was the hope that the Fed was that negative data would force the Fed to take more action. Correct. And we all remember those markets. So Mark, in your opinion, is that philosophy, does it have any credence in this marketplace that we're going to be buyers at these levels and take on the risk to the downside? Because if the market ever goes down again, the Fed will act quickly and aggressively in staving off any of this price action.
I think that general sentiment is widely held amongst the investing class right now, amongst Wall Street participants, that no matter how bad it gets, the Fed will help. No matter, like there's that old saying about bad news is good news, which would explain today's price action in the old days. That, hey, bad news on unemployment, which means the Fed is more likely to do something. And that would explain like where you'd have bad news and then you'd see the market rally rally big time. That line of thinking is dead right now because the market has totally bought in that no matter how bad this gets, the federal government and the Fed will do whatever it takes to prop up the market.
Yeah.
That is that general thesis. So any individual news is irrelevant right now as long as that holds. Now, can that hold indefinitely in the face of what likely will be a tsunami of bad news down the pike? We're going to get bad news on economic data. We're going to get bad news. I mean, not just bad news.
It's going to be the
understand.
worst economic data we've seen in decades.
No, screw decades, our entire life. It is going to be the worst economic data that we've ever seen in our entire life. And the earnings are going to be abysmal, particularly on some companies. So, I mean, you got to ask yourself the question, because here's the battle. Go back, and this is a larger version. Do you fight the Fed? Do you fight the Fed now being the Fed and the federal government, who will throw unlimited resources in the face of what is going to be not just bad data, not just abysmal data, historically bad data, in the face of a recession? At some point, doesn't that sentiment break?
All right, so here's the thesis then, right? The virus could peak over the next month. The pinnacle, the apex, we could see a peak over the next month. So that's the start of the investment thesis. The second point is the economic damage will be horrific and it will be swift, but the recovery will also be very quick. And if anything bad happens to those first 2 points, the Fed is going to have their back and the government's going to do bigger stimuluses. That's the thesis, correct?
Yes, and that's my thesis too.
All right, but here's my one point. These people, Secretary Mnuchin, President Trump, Jerome Powell, Bill Ackman, John Tudor Jones, these people are very intelligent, very successful individuals. But I've maintained one simple philosophy in over the last 12 years, that while the Fed and the government cooks their fiscal policy and their monetary policy in some kitchen somewhere, what they don't understand is people. How in the world are people, consumers of America, which has been holding this market up for 3 consecutive years, based on their consumer spending and then their issuance of debt from a spending perspective as well? Are these people, simply because the government or the Fed wants them to come back to work and wants them to start spending their money and wants to have them behave like this environment never existed? Are consumers simply going to behave the same way in the future, i.e. the next 6 months, next year, the same way they did from 2010 through 2020?
Here, let me give you some stats from a Gallup poll that lets you know how consumers are behaving today. And then we can extrapolate that, because I think this is the big question you have to ask yourself, what Matt just asked. 72% of Americans are now practicing social distancing. 92% of Americans are now avoiding large crowds as well as mass transit. 87 are avoiding all air and other travel involving crowded transit venues. 68% of Americans are even avoiding small gatherings among their own family and friends. All right. I mean, these are massive numbers of giving you a reflection. If you're not alone out there. If you're avoiding these things, guess what? Almost everyone in America is with you right now. So that's the current state of human behavior as far as interacting with one another. Massive numbers. How quickly can that change over time? Well, Mnuchin would have you believe that it would be like immediately.
Next month.
Yeah. Like, yep, people are just going to go back and act normal.
That's the theory, Mark, is that all of these policies aside, the government and the central bank simply believes that the consumers are going to come back and participate in the market to the same degree that they have historically participated in the market. But I just don't believe that.
Well, okay. So right now, I mean, think about this. 92% are avoiding large crowds. So if you would believe what Steve Mnuchin would say, that number is essentially going to go to zero. That at some point in the near future, he wouldn't say this week, next, but this thesis they have is that consumer behavior is going to rapidly change to the other side. That to me seems like a suspension of reality. There is no way that you don't have a percentage, as long as the virus exists, as long as there are pockets, as long as it's there, which we can all agree right now is going to exist on some level. Now, whether it exists on a working level where America can get back to work to some level, that's a separate argument. But on some level, we're going to live with this virus in some way. There is no way that you are going to have this mass, 92% avoided large crowds, but now it's only 7%. No, I mean,
consumers don't come back that way. They never have. Consumers take a while.
There's a psychological impact. I mean, when's the next time you're going to feel comfortable sitting down in a crowded restaurant or a semi-crowded restaurant? When's the next time?
It will not be this year for me.
When's the next time you're going to feel comfortable going to a jazz game? When's the next
or the movies
or getting on an airplane? At some level, a pretty significant percentage of the population is going to curb their appetite. Now, as the virus peaks, we hear that number, as people become less afraid, are these numbers going to come down? Of course they are. But that doesn't mean you're going to see this massive flip. You're not going to see this massive flip. And that has bottom line impacts on companies' profits. That has bottom line impacts on companies' revenues. That has bottom line impact on the economy because we are so consumer driven. And now multiply that by the world, right? Multiply that by the world. So like to think that you're going to be able to flip it on a dime and turn around and there, everything is awesome. This is going to be a slow shift back into the reintegration of society with one another. It is going to be a slow shift back. Yeah, you'll slowly shift back where you'll visit your family or this or that. But we're also not even taking it into account when that shift might even start to occur. Like these lying sons of bitches in politics and the Bill Ackman types, because they are lying and they are creating this fanciful universe for you for their own selfish purposes.
Yeah, the level of manipulation is really kind of unprecedented here today. It was fascinating to see the coordinated effort when that initial claims number came out from both the Fed as well as the government, and I just see this as a level of manipulation that is unprecedented. But I just want to remind everybody of one thing: every single economic projection the banks, the Fed, government has had over the last 5 years has been wrong. Every single one. They expect this economy just to be rip roaring by the third quarter of this year. They're wrong. They're 100% wrong. The economy takes a long time to recover after it gets shocked like this. The economy gets rocked in the short term and then it recovers in the long term. The labor market gets shocked in the short term and it takes a long time for the labor market to recover. In 1 year of 2008, we went from 4% unemployment to 10% unemployment. We're going to do that in a month this time, and it took about 9 years of average gains in the labor market per month of 200,000 to really see that labor market get back to where it left off in 2007. Anybody who thinks there's going to be a short-term economic recovery after what we've been seeing, I do believe is completely foolish.
Yeah.
Well, and on these trends, because these trends, I think, go at the heart of things, right? Now, if these trends were 2%, and we were just dealing with the virus and people were like charging the bill and says, well, some of us are going to die, but we're going to get back, that would be one thing. Their whole thesis would be correct. But not only do these long-term trends have to shift for you to feel like you're getting good value on certain companies, when do these trends even start to shift slightly in the short term? Like, what do you guys think? Because they have to shift in the short term before they shift in the long term.
Economic trends, people trends, anecdotal
interaction
evidence.
trends. Because these interaction trends, I think, are at the heart of it all.
Yeah.
If people aren't doing things, the economy's not going to get better.
Until the
right?
virus, well, first of all, until the virus outbreak slows down, why would people want to even be doing things? I don't want to see that trend actually shift. I mean, one of the biggest risks we have is that we rush this thing and we get back to work and people do ignore this information mark, and that we have a larger spread problem that lasts a lot longer than what we could have flattened if we continued with the course that was laid out about 10 days ago, you know? So do I think people will change their behavior? I think in a more restrictive way over time, Mark, because the data is going to get worse. I mean,
I'll answer your question very directly. If we see if we see the apex, say in the next 30 days in California, New York, and U.S. data, we start to see the velocity, slow down, and we can start to understand maybe we have an apex. It will take years for the consumer to come back in and participate in the market to the same degree that they did before this fear and this panic really kind of set in.
Mm-hmm.
Years.
Yeah. Yeah, consumer confidence up in the 130s and savings rate at 0 and credit to the max and everybody taking out home equity lines of credit to go on vacation. I don't see that. So this roaring market that we were in for a long time, they can print as much money as they want. This $2 trillion, guys, is 10% of GDP annually. Now, the promise that they're going to have more and more and more and more and more down the road. Yeah, we'll see. We'll see what they can continue to do. And it doesn't necessarily change global consumer behavior, which is one of the most important parts here. India is still going to be closing down. It doesn't matter what we do in the US. Many of our goods and services are exported around the world. We can't just change the way the globe is going to react to this because we want to get back to work. That's not the way it's going to work. So, but in the short term, there's the old saying, Matt, markets can stay irrational longer than you can stay solvent, right? You got to trade what you see in the short term because the price action is real in front of us. Yeah, we have 3 strong green candles, right?
I trust 5-minute charts. That's what I trust. Yep. Guys, it took an unprecedented $6 trillion in total stimulus just to drive the market up three consecutive days.
Mm-hmm.
6 trillion, 4 trillion in Fed actions, 2 trillion in government actions, just to form a bearish retracement.
All right, I want to ask you all this because this is when I've talked about day trading with pro members, I tell them because I have a bearish long-term thesis, like I'm sure many of us do. Does anyone not have a bearish long-term and like 6-month, 9-month thesis?
No, I have a bearish thesis.
No, what's your take on this? We don't ever bring you in on this one as much as we should. You're on mute, young man. Maybe he doesn't want to share it, Mark. He's okay.
I'm just talking to myself like I normally do. But, interesting dialogue in my head. No, I think that this is going to be a limited time rally, and then we'll see more downward price movement. It'll be probably a slower grind. If you go back and look at the data from the crash of 29, I think that's a pretty good expectation because there was a very, very sharp initial sell off. Like we see here. And then it was just kind of a slow grind for the next couple of, 18 months or so where it did continue to, trend down, but just not as fast and not as dramatic.
Mm-hmm. Mm-hmm.
Anyway, now, the one thing I tell, because so you have this overall thesis, but then you go into day trading and you have to, and I've said this with fervor, you have to let your long-term thesis, whether bullish or bearish, you have to leave it at the door when you enter the realm of day trading. You have to suspend all thought and go purely on price action. What are some tips for people to do that? Because I guarantee, like on some of the breakouts, because there were some nice signals, breaking resistance levels, you cleared like the 5-minute 200 moving average. There were a plethora of signals that a lot of people on an up move would have said, I can't do it because the market sucks. I can't do it because they can't trade to the upside right now.
Mm-hmm.
What do you tell individuals from a day trading
Mark, that's a
perspective?
fantastic point because that's the thing is that if you're trying to let where market's going to be a month from now and 3 months from now, if you're day trading, are you going to be in that trade a month from now, 3 months from now? No, because that become a swing trade or an investment. You need to let the time frame that you're analyzing the charts equal the time frame you plan on staying in the trade. That's what I would say. If you look at the chart, you see the price action, you say, this intraday chart is bearish, I'm going to go short, but I'm only going to be in this trade 5 minutes to an hour, maybe.
Mm-hmm.
And that's how you need to look at it. Because if your long-term thesis is one direction, which is opposite of your short-term thesis, well, then why are you letting your long-term thesis get in the way? Understand the difference in time frames, not only of how to analyze charts, but also on how long you plan on being in the trade.
Yeah, you're looking at a potential day trade setup right now on the S&P 500 as you're forming a little bit of a high base on that 5-minute chart, and you're threatening a little bit of a breakout of that 2588 handle. If you're looking at making that trade, you put your entry above the 2589, let's say, put a stop loss down underneath, say, 25. Where would that be? Somewhere around 25, 80, I would say. You're targeting 2600, and if it gets to 2600, you adjust your stop loss and the momentum trade above 2600, and you're probably in that trade for the next hour to 2 hours, perhaps maybe the next 15 minutes, who knows. But I don't care about like literally an hour from now. I'm looking at that data right now. So when you're day trading, you don't care about the economics of the situation. You don't care about the fundamentals of the situation. You care about price first, price second, and price third. That's all you care about.
Yeah. Price action.
I would add modest position sizes and trailing stop losses.
Yes.
Yeah. Well, and if you're emotional about your entries, you can't go long. There's probably something about the way you're reading the market right now. And maybe you shouldn't be in a live trade. If you can't take a signal in front of you, that's an obvious signal within your rules. There's something you're suffering from an emotional perspective. Maybe you take the day off market and revisit your rules.
That's a fantastic point there, Tim, because the market's not emotional, and you shouldn't be emotional when you're trading the market. You should be trading the market off of data. The market is data.
This market is today evidence and will become a Forex market from this point. Let me tell you what I mean by that. For the longest time in equities, economic reports haven't mattered at all. Zero, nada, nothing. Like, economic data comes in. But any Forex trader knows that, like, they develop systems around the release of economic data, because economic data has always influenced currency to some degree or another. Excuse me. And so, like, economic data, the release of when is the last time in history that the jobless claims mattered in the equities market? Like, it doesn't. But those type of things influence Forex quite a bit.
2008, that's the answer.
And so moving forward today and other days, you are going to see economic data serve as triggers. And so learning to trade the news is going to be a big part of day traders' routines, the economic news, not the broad macro news. And we haven't seen that in equities in a decade. Forex traders know exactly what I'm talking about. Economic data serve as a ton of day trading movement. Get used to that in the world of equities.
Good old-fashioned news-based trade this morning, no doubt about it. Unemployment claims came out, and the market sparked this rally.
It was a news-based trade.
Yeah,
this is a Forex trade.
Yeah. The bill itself, Matt, what was your read on how they use the money, the $2 trillion?
Well, let's just go through the numbers very quickly. The Senate has approved the stimulus package. It's a $2 trillion stimulus package. The House has not voted on it yet, but it does look like the House will vote on the bill. I believe tomorrow is when I believe the House will vote. And I don't believe you have to be physically present to vote on the bill. I think they removed that stipulation. So the House, which is obviously Democratic controlled, is going to be voting on it. But Nancy Pelosi has already came out and basically stated that it's going to pass one way or the other. They might have a couple things to, say about it, but it does look like it's going to pass the House, and President Trump has indicated that he is going to sign the bill as well. Here are the numbers, and here's what's in the bill. First and foremost, let's talk about what corporations get. $367 billion to small businesses. There's $100 billion to the healthcare system. There's a $500 billion slush fund that they can basically utilize in whatever purpose they want to. Tax credit for employers up to 50% of employment tax. They're also delaying payroll taxes. So of the total $2 trillion stimulus, a vast majority of it is going to corporations. In what I do consider this bill to be, and this is just my opinion, but I'm going to share it anyways. I consider this bill to be a corporate bailout bill, and it is very, very light on what it actually does for the populace. What the populace gets is, if you make less than $75,000, you get $1,200. If you make less than $150,000 as a couple, joint, you get $2,400, $500 for each child in that capacity. Anybody that makes over 100,000 or over 200,000 joint gets nothing. And these are based on 2018 tax returns, not to reflect what's actually happening right now. They're also boosting unemployment by $600, and they're
And Matt,
also
on that point, that's one of the other things that doesn't make too much sense. People who had good jobs in the past year because of the economy, and people who got jobs the past 2 years, their tax returns now versus 2018 is way different.
They're vastly different, Cody. Vastly
the way
different.
They grew their budget, or the way that they, maybe they bought another house recently because, they both got good jobs. Now they're both laid off. Like, their 2018 tax return isn't going to reflect that.
It's not going to reflect any aspect of that. It's way too far back. What they should have done, in my opinion, is basically just go based on Social Security number. And if your 2020 tax bracket is in those levels, you have to pay back the taxes in your 2021 year.
You have nothing to worry about. Those people that lose six-figure jobs, they're just going to get hired right back. Steve Mnuchin told me that this morning. He said they're immediately going to get hired back in a couple weeks.
Okay,
they're good. They don't have anything to worry about.
They're also suspending student loans until September. That's not a debt forgiveness. They obviously tack on that to the end of the student loan.
For it.
So you do have to call your student loan provider. But in a nutshell, guys, again, this is very, very, very corporate driven. Obviously, it's a corporate bailout to a large extent, and consumers get what they get. But that's what's in the plan, guys. What are your thoughts on it?
The one component of the plan I need to noodle through and actually think and see exactly how it works. I did see that they were going to extend unemployment insurance to gig workers and independent contractors. And I don't know if that's clear. I don't know if that's true, exactly the way it's going to work, Matt, but I think that would be a big change.
You can't just make announcements like that without a lot of red tape being removed and without it having a very, very difficult time in terms of the application of it. Yeah. And that's kind of the concern here is how is all of this going to be applied? In what time frame is it going to be applied? How are they going to control the regulations around that? There's a lot of open questions here. But again, that's what's in the plan. It's a corporate bailout plan.
I think what happened
Matt, like
here,
Mark said, Mnuchin said this morning, it's going to be 3 weeks, right?
Mm-hmm.
Yeah,
they're going to see the check.
If anybody believes anything that is coming out of the government or the central bank at this moment in time, they are manipulating everything right now.
I do not see those checks coming out in 3 weeks. I don't know where that number came from.
Larry Kudlow 3 weeks ago said the virus was contained. So, if you believe propaganda coming out of Wall Street talking heads on CNBC or Steve Mnuchin and Larry Kudlow, then I don't know what to tell you. They said they have lied every step along the way. Why are they telling the truth now?
Those talking heads make money when you buy and when you're working. That's what they need.
I think the bill was disgusting, quite frankly, Matt, if you want me to be very honest. I think that so much of the money going towards corporate bailouts from companies that mismanage their funds for a very long time, that we do not even have guarantees on what they're going to do with the capital all across the board. And I have no idea why.
And by the way, there's no guarantees in the bill that forces employers to actually maintain a certain labor market. There's no guarantees in the bill that forces them to rehire their employees. In fact, Mnuchin said today his hope is that these corporations that are benefiting from this bill will just miraculously start hiring people again. It's nonsense. It is what it is, but that's what's in the bill.
Yeah. And I guess the promise is that we'll take care of you later. We're going to come back with another big stimulus package down the road. Maybe the next time they'll actually help workers. I don't have any confidence in that. It seems like anytime in situations like this, money does go to these companies, Matt, for bailouts. And the same old argument for 40 years, by the way. If companies are doing well, they'll hire people and it will trickle down through the economy. We know economically that's absolutely a lie. It just does not work that way. Anyway, markets like it here in the short term, no doubt about it.
But the market didn't buy on that.
I don't.
That's not what the market bought on. The market did not buy on the stimulus plan. The market bought literally on the second the initial claims report came out.
Yeah, Tim, I think you have to suspend, and I think this is very important for all of us because Bill Ackman doesn't make our personal investing decisions. Steve Mnuchin does. We have to. And I think there is this trap, this mental trap out there that, oh, the market likes it, so that's going to be stability. That's going to put it in the floor. Market didn't do this. This was 33,000 futures contracts in the first 5 minutes of the jobless report on a news trade that triggered algos and short-term day trading sentiment. That's all it did. So it's not that the market as a whole, oh, everything's good. You have to understand how price action works on a short time frame to realize that this isn't some big, huge market shift in sentiment.
No, nobody clicks on the headline that says initial claims report sparks 33,000 contracts being traded in 1 second by Citadel, sparks a day trading environment where the trend lasted for the next 4 hours.
They don't actually. That would be news I would click on, by the way.
But you would click on that.
That's an article I would read.
No, nobody writes that on CNBC. They're going to markets up on stimulus plan or markets up on initial claims collapse or whatever it is. But it's just clickbait nonsense.
How many of the journalists are actually traders, do you think?
None. Zero.
None. Yeah, like they're the ones creating the headlines. They don't even understand what's.
Nobody wants to see how the sausage is made. They just want to say, mark it up. Why? Yeah. Because, no. I mean, you got to understand how when you're making these long-term investing decisions, understand that today's price action is nonsensical. But it's totally sensical from once again, that Forex news. You see this stuff in Forex all the time, and you are going to continue to see it. Economic data comes out. It triggers a reaction. Doesn't matter if that reaction is rational or not in the short term. It triggers a reaction, and then it's off to the races. And then what shorts are going to come in to the face of a locomotive? Like,
let me put myself on the record here. I think this is a massive pump and dump, quite frankly, by Wall Street. Wherever that pump ends up at, Matt, maybe higher than here. I think this is a massive pump and dump.
I think we have a couple limit down days in our near future, guys.
Yeah.
Bill Ackman wouldn't do that to us.
Oh yeah, sure. Yeah, Bill Ackman.
Oh, the bastion of humanity, Bill Ackman.
Yeah.
Today, guys. I mean, this market is a day trading environment. That's what it is. The market will return to some degree of normalcy in the future, but again, as I've said for the last month and a half, that day is not today.
Nope, not today.
And by the way, you could see a repeat of what happened yesterday coming into the close. Keep an eye on that.
Yeah, we're testing this consolidation range up here at the high right now. It's going to be interesting to watch. Some other things I wanted to do here during our show. Let's go through oil real quick. Crude oil, by the way, massive rally in equities. Crude oil is not getting the message. In fact, Goldman Sachs came out, Matt, and they even said that oil glut is going to last for a very long time. They were calling for Brent down at 20, and that put crude light sweet crude around 18 here. Another, 10, 20, 30% down is kind of what price projections are across the street. What's your read on crude oil here?
Same read I've had for a very long time. I see crude oil at 15 in our future at some point.
Yeah. Mark, obviously crude is not responding.
And very quickly, Tim, that Goldman Sachs report today was kind of threw a lot of cold water on the philosophy that America and Saudi Arabia and Russia were going to come back to the negotiating table to cut the oil supply. And Goldman Sachs even said today that even if Russia, even if America, even if Saudi Arabia all came in today and literally just said, we are cutting down to nothing, they still see oil going down because the glut that is creating from a supply perspective around the world. And obviously with historical less demand, that glut of supply, like literally Goldman Sachs said, it doesn't even matter if they have cut, you're still going to see a decrease in price action on oil. And obviously oil taking on the chin down about 6% on the day. To me, it's still very, very bearish environment for crude oil.
Definitely a bear call on oil. Noah, give me a quick look at gold and then the dollar. Then we're going to talk individual companies. Break the charts down if you can.
There we go. Gold showing some life here on the daily chart. Let me zoom in on that a little bit. So you had a nice little retest up there in the 1700 ballpark and it pulled back for a day. And then we're seeing another, up day here. I think our long gold thesis is pretty sound. I keep reading about shortages and things of that nature. I've also been reading about some of the big firms not being able to deliver on their contracts. I think you're going to see this continue to rise. Again, you might see some more margin call action, but I think you're going to see it continue to rise. And I'm watching for a cup and handle type breakout on this. Above 1700 would be a strong signal for the bulls.
Mm-hmm. Yeah, obviously, tradable signal up there. Fundamental argument still stays same. Nothing really to update on gold there. But I will say on the dollar, guys, we're seeing a big sell-off here in the U.S. dollar today. That short squeeze, whatever you want to call it, lack of liquidity, lack of dollars available there when it busted out, Matt, and rallied. Now we're coming back and we're going to be retesting old resistance right in here. We're below the 100 mark, which is that magic number we always pay attention to. What's your read on this currency right now?
You know, obviously a lot of downward pressure in price right now, trying to cling into that support level right around that $100 range. Obviously, you're breaking it right now, retesting old support levels. We were looking at the dollar over the last couple of days, and on Tuesday I made the argument that this is potentially setting up as a K-trade environment above 103 or underneath 101. Yesterday we broke it down on that 30-minute chart where we had that very, very clean trend line on that 30-minute chart. Now, if you kind of break it down on a 30-minute chart perspective, you had a very clean resistance area, and we had the discussion whether or not you can play it above 103 or above the trend line, and it just never really kind of confirmed that trend line. It never broke up above that trend line, and once it got underneath that 101 level, I guarantee a lot of stop losses got triggered, and you saw a lot of price depreciation on the day. Dollar still reigns supreme. Obviously, the last few days has been a little bit of a pain train for the dollar, but at the end of the day, it just didn't confirm. Those things happen.
Yeah, did not. It's on its way back down here in the short term. Obviously, the dollar flight to that safe haven here a couple of weeks ago, flight away from it here in the short term. We'll see how this thing reacts as we head into the weekend. Take a look at some of these companies here, Mark. Ford, and I actually saw that Macy's as well. Let's stay with Ford though. They had their credit downgraded to junk rating by the S&P here today, which, by the way, I think I was reading into this means they can't borrow from the Fed. And so even some of their issues that they have, Mark, we've seen downgrades across the board in credit ratings with many, many companies. Does that, what does that tell you, by the way?
That they're going to start hiring again immediately.
Yeah, seriously, I was actually formulating a better version of that joke, but
is that how you come out and criticize my joke by saying you were right on the precipice of getting a better one?
Obviously not in line with the bullish sentiment today when
no, not only was Ford downgraded to junk over the last 2 weeks, you've seen more downgrades into junk it's approaching a record for a 2-week period of the number of companies downgraded to junk. Now,
I saw that too, Mark. Do we have the actual number of S&P 500 companies? I just read the report that said it's been massive.
Let me see if I can. I don't know.
Well, let's put our team to it. I don't want to stop your thought. Can anybody really quickly Google amount of S&P 500 companies that have been downgraded into junk territory?
Junk ratings. Yep. So Ford has to issue junk bonds to be able to get financing and debt to be able to put workers back to work when they still.
Which means they have to give a higher interest rate when they're loaning out that money, which puts more long-term taxing on their. The plain and simple fact is these downgrades in bonds across the board at a record level. I believe the record was in 2002. It points to this once again, like when you're out there and you're like, oh my gosh, and you're experiencing FOMO and you're going to miss out. And I missed the buying opportunity of a lifetime and all of that. Realize that there is nothing in any data point that you see that does not point to really, really, really hard times in front of us. Ford and a lot of companies like Ford are going to have a really hard time. I mean, you have people just aren't going to, if the Harvard epidemiologist that just did a Facebook Live and said, let me give you his exact quote. Steve Mnuchin can say one thing. Larry Kudlow can say one thing. He said, this virus is not going to go away in 2 weeks or 4 weeks or 6 weeks. We're going to live with it in one form or another for 12 to 18 months if we're lucky. If we are living with it, and then he says, once we have a vaccine that's effective and widely deployed, we can bring the pandemic to an end. Until that time, we're going to continue to have to confront and deal with the virus. I think that is I mean, from what we know, now that doesn't mean that we're all shut in. That doesn't mean that society isn't returning to forms of normal for 12 to 18 months. That's not going to happen. Americans will reject that. But companies like Ford, companies like Delta are going to have to deal with shifting consumer trends.
Mm-hmm.
And bottom line impact. As people are laid off, as people have a base amount of money to live, like you're unemployed and you're making a base amount of money, that base amount of money is going to go to rent, food, clothing, healthcare, those base needs in life. But people aren't going to go out and buy a $100,000 car, a $70,000 car, like they once did. So the profitability of these companies could be impacted for a very long window. And
Hey, Mark, can I ask you a question on that point you just made? Because I think it's an important discussion. American consumers are not prone to save money, correct?
Correct.
Okay. Does this situation that is unprecedented in our lifetimes, does that cause them to see how they see the utilization of money and the utilization of debt in the future, to the point where they start saving for a rainy day, so that if anything like this happens next year, the year after, that they're going to start changing their consumer, their typical consumer behaviors?
Oh, that's a tough question.
For about 6 months to a year, maybe.
What
We'll
if they
see.
go negative? What if they go negative rates, and that discourages saving altogether anyway?
Well, consumers don't understand anything about that. They just complain that they don't get paid anything on their savings account. But we're already at a certain degree of negative rates. You have the 1 month and the 3 month bonds are already at negative. Other longer term bond horizons are probably going to turn negative over the course of time as well.
Mm-hmm.
I mean, just ask yourself, your average family of four, and let's say they're not adversely impacted with their job right now. I mean, it's hard to argue that in the short term, they're not. I mean, we've never experienced this, right? This is a shock to the system. Holy cow. I mean, don't you naturally just tighten up a little bit? Don't you naturally just tighten up a bit?
Maybe,
Yes,
but what do we know about human
I think
behavior?
it's a short-term response, not a long-term,
But
because they may save money, over the next few months into the end of the year. But as soon as they start, money burns a hole in people's pockets, and they love their short-term love more than they know.
But we're not talking the same degree of economic concern that they've had in .com and they had in, a subprime market where it was really kind of an economic scare. And consumers took a couple of years to get back to the same consumer behavior. We're talking about something that has rocked the fear gauge in the American consumer to a degree that is really kind of unprecedented, guys.
Mm-hmm.
Well, I mean, what do you? Okay, so even if you say no, all right, let's say no, Cody. Let's say in the short term, yes. Long term, maybe not.
Well, let's ask the team real quick. How many of you guys out there today are going to change the way you see money based on this unprecedented situation from a healthcare perspective? Are you planning on saving more money for a rainy day fund?
Well, Cody's already a 75-year-old man that's been saving money like that since he was 12. So,
I wouldn't put me back that far. My awakening was probably in college.
So anyways, needless to say, Cody, I have no doubt Cody saves his money to begin with.
I'm hopeful, Matt. I hope people do. I hope people will learn from this. I hope people will learn about investing and protection and hedging, learning how to buy insurance when the VIX is at 15 instead of when it's at 75,
But here, let me be Dr. Doom again. All right, so let's say consumers don't change their behavior even in the short term. All right, they just spend, which I don't think anyone believes that. Fewer people have money to even do that. What do you think lending agencies are going to do to automobile loans? Do you think they're going to be more loose or more tight in this economic?
With banks loaning consumers money?
Yes.
Banks will tighten up on loaning consumers money.
Yeah. They'll tighten up.
Think so?
They will tighten up. They will
absolutely.
Tighten up.
100%. Absolutely.
So
I think they might loosen them, but then they're going to increase the interest on them, which is just going to make it harder for consumers ever to get ahead.
I mean,
you're going to see a record amount of bankruptcies over the next 2 years. They're not going to,
Oh, yeah.
they're not going to be borrowing more money to consumers.
Mm-hmm.
and so companies like Ford in this situation, they just feel they face this gigantic uphill battle over the next 12 to 18 months to in some cases survive, but certainly to have anything resembling thriving. I mean, that's a lot of things to overcome in an uphill. So if whether you're a restaurant or Ford or a movie theater or a casino, you have this really big uphill hill to climb. And so it's like on these rallies that all of these stocks have had this week,
Mm-hmm.
man, if you think that these companies are just in a position to thrive, now I do believe, and one of my overall thesis is that these companies, the government will not let Ford die. They just won't. They won't let companies as a whole die. They'll keep them afloat. But that doesn't mean that they're going to thrive in this environment. That's insanity to me.
Is it? Because I'm pretty optimistic, Mark. You're making a serious buzzkill here. I'm optimistic. I think people will come back out and come out punching because they'll be all pent up. There'll be all kinds of pent up energy, and yeah, we'll have to lick our wounds and get our boo boos
Don't
kissed.
lick your wounds.
Oh yeah, don't lick your wounds. Definitely don't lick your wounds. But no, we're gonna have to come out of this, with the gloves on and just fight. I mean, that's what it's gonna be. Is that yes, we may have an uphill battle, but we've got that fighting spirit. So I think we're up for the task.
Mm-hmm.
So
I will
I'm
say,
very
from
optimistic.
From looking back 2008, like
So
we can
Noah,
all agree there should have been.
hold on. So Noah, are you suggesting that the consumers will come back out and behave the same way that they have historically?
Old habits die hard. People are reticent to change. And so I think that once they have restored their income levels, they will slowly, but very, very surely, and again, very surely, they will resume their consumer. Again, unless something goes so prolonged that it's not, but I think we will. I think people will get back out and start consuming as regular, especially after being pent up. I think they'll come out. So I'm optimistic. I'm just saying,
that is assuming that their income levels are where they are as a collective.
Hope should not be a trading strategy, though.
No, it's not a trading strategy. I'm just talking about an general optimism. I'm going
You
to
need to
trade.
be data driven.
I'm going to trade what I see on the chart. Make no mistake.
Listen, I get it, but if the data is negative, we have to be data driven.
Mm-hmm. Couple things.
And I've heard the pent up, like people. I mean, that's the whole Mnuchin argument, right? That's the Mnuchin argument. It's that when things start to unleash, people will just go back to normal. Companies will go back to hire.
And what lessons are they learning? They're learning that when things go bad, big daddy government comes and bails everybody out. So will they change their behaviors? Maybe. The prudent ones will, but the average person will be like, I just got a government check and everything's cool. And then they'll find another job as soon as they can. And it may take a little bit of time, but they won't necessarily learn the hard, stuff that maybe my grandparents learned because they got the bailout.
Well, and I don't think there's a debate on that. The American way of life will certainly come back in a certain time frame. I think the debate is in what time frame does that American, lifestyle and mentality really start rip roaring? Are we talking weeks? Are we talking months? Are we talking years?
I think we have very short memories.
Well, but
if the medical response can get it in the clear.
if they can keep this in the clear.
Which is, by the way, the whole point. One real quick point here, Mark, and I'm loving this discussion, by the way. And I think there are, the most important thing we can learn here is to be data driven, focus on what the information is. And Matt, what you said earlier, as a day trader, price. By the way, the market is coming back here on the intraday. I do want to take a peek at that in just a minute. But to me, the most important thing that was said in the last 24 hours was actually said out of Fauci in his interview last night, that the virus will set the timetable. So yes, Noah.
And Powell said that today as well, Tim.
If we take the appropriate actions to actually curb and flatten the curve, and we came together as a society, and then we've got the virus at least at some point where we feel like we've got a medical response, a healthcare response. Yeah, Americans are going to come out and do some great things. When that happens, we have to wait and let that data come and go through it. And obviously, I think there's some opportunities to learn some life lessons here.
The American spirit is extremely strong. There's no doubt about that. And the American spirit finds common ground in times of crisis. And we've already starting to see that. But when we look back at those situations where we came together in after 9/11, and when we came together after the Great Depression, and as we came together in World War II and so on and so forth, we were still talking years, guys. We weren't talking, we're in this situation a couple weeks.
Yeah, no.
So Noah, what are you out there buying today? If you believe in the pent-up demand argument.
Are you kidding? You want to know the truth? I bought some ducks because they lay eggs.
Ducks, duck eggs.
I'm not joking.
Duck eggs?
All right, all right.
Got some baby
Because
ducks on the way.
for the pent-up, because you're going to hear this pent-up argument. I mean, the one it's out there. It is the basis, right? It is the basis for the whole V-shaped recovery that Goldman Sachs now are pulling back on. It requires there to be on the healthcare side for things to be better there. If we're dealing with the coronavirus in some level for 12 months, I think the pent-up argument is lunacy as long as the healthcare situation exists.
The V-shaped recovery happens once the healthcare crisis is at an apex, and we start to see the downward trajectory and the yield and the curve start to lessen. At that point, I can buy into the argument of the pent up America, let's go buy everything at that point. But until we see that in the data, I think it's very important for everybody at Team Tackle to be data driven and not opinion driven.
And Mark, I want to make 2 points, or Matt, I want to make 2 points about the apex. Okay. Apex is still meaning that numbers are going to keep rising, which,
yes.
So we're going to see things getting worse.
Well, and they still rise after that, right, Cody? It's not like they just all of a sudden fall off the curve. They just don't rise at the same velocity.
Exactly. It's the massive peak, and the testing that's coming out, the instant test, that's going to be a lot faster. It's looking at antibodies that will not only allow us to see who is currently infected, but who's been infected in the past, and those will start going in as confirmed cases. So we should, because I do believe there's.
And Cody, will you talk about the United Healthcare, who came out today and said they are introducing a new test that can be self-administered and respond and get the the positive versus negative within 20 minutes?
Yeah. So it's a really cool test. What it is, it's similar to like a at-home like diabetes type test. It's going to be at most doctor's offices, so it's not going to be like a Walgreens anytime soon. But basically, you prick your finger. It's going to give you, you're going to put some blood on the sensor. It's going to start measuring the antibodies for the virus. So we're not necessarily testing for the virus itself. We're testing for your body's reaction to the virus. Mm-hmm. So that's why I was saying that, we'll be able to see not only who has it, but who also has had it, past tense. So we're going to start seeing that number of confirmed cases go up, because I do believe that there is a large number of population that we don't know about that maybe never presented with symptoms, maybe, teens and early 20s that, maybe they just felt down for a day and the next day they were fine. So this will be a good thing, but this will also cause those numbers to
It'll be scary in the short term, but it's a positive in the long term, right?
Yes, exactly.
Yeah,
exactly. It'll scare the crap out of consumers in the nation when they start seeing the number of confirmed cases go up.
Will it scare investors or Wall Street when a lot of us fully expect those numbers, especially as testing rapidly does increase in America? We all expect those numbers to radically increase from a population perspective. But I do believe, and I've held this opinion for a long time, although testing will have a negative impact in the short term from a numbers perspective, it's going to give us an understanding of what's happening in the long term to really kind of assess the damage that this healthcare situation has obviously undertaken here. So I think that was positive news out of United Health today. I really like that news.
And real quick, Scott, to answer your question, I think you're thinking of white blood cell count. So antibodies are specific to different diseases or viruses. White blood cell count is any type of infection. So we're not just looking at white blood cell count to see if those are elevated, because that could be any sickness. You're right. There could be the common flu could cause your white blood cell count to increase. These are actually the antibodies for COVID-19. So they're unique in that fact.
Mm-hmm. Mm-hmm. I maintain the thing we've been talking about forever. Virus containment and the healthcare response is the most important economic thing to watch in the long term for your thesis, quite frankly. And I'm hopeful with all these things you guys are talking about that we can get more data, more testing, understand where it's at better, maybe even map out that apex on when we're going to get there and start to paint a picture that is beyond that. But I'm not there yet personally. I'm still focused on the
Well,
data.
no, I mean, we obviously got to be data driven, but if rapid testing does take hold and we continue social distancing, we're talking weeks, not months in terms of
That'd be
apex.
great.
Would you agree with that, Cody?
That'd be
Yeah,
awesome.
I would agree with that. It would become weeks, not
Okay.
months.
Yeah, that would be
Okay.
awesome
Because
too.
the more data that would come out, it would instantly be able to give us more clarity. Because this entire time, I mean, there have been health officials that even said, like, I mean, this thing was new. We've been kind of, playing this by the seat of our pants, trying to figure it out as we go. And until so the formula of what epidemics look like, what all epidemiologists are talking about, we're still filling in those numbers and trying to figure out what those X values are and what that N value is to really actually get the number of total infected cases or death rate, because those numbers keep changing as the numbers within the equation keeps changing. When this first started, we thought the death rate was up 8% or something, and that's it's coming down as we're having more testing. So it's like they're going to constantly change. We're really not going to know what's happening until this is all done, like years from now.
That's right. Let's flash fire
But
through.
isn't that kind of what happened very quickly with the SARS and H1N1? Is as more cases came out, it was initially scary, but over time that death rate started coming down because you're testing more people that actually had it.
Exactly. I believe it was H1N1 when the epidemic was happening. They thought the death rate was something like 11%, which is unheard of.
But didn't it finish somewhere like 1% or something like that?
Yep, it finished at like 1.3%.
Yeah, that's probably going to be the scenario here. At least that's what I hope.
That's kind of what I actually read a study. That's what they're projecting on the data on this one, that it's actually probably closer to a 1.5% instead of the 3 or 4 that we were worried about a month or two ago.
Yep. And that's,
so we'll see.
It's just it's that formula of trying to figure it out. And as the more data comes out, we're going to know more. Yep. So we're flying by the seat of our pants, trying to figure it out.
If you want to play the hope card, there are studies, and models that say that it's even much, much less than that.
I've seen some of those, Mark.
Which is why we need testing. We want the data. The unknown is scarier than the known. I want to know what the information is. I want to have that plan laid out for me personally. I think that would be the best.
Well, that's Wall Street. Wall Street prices in positive news and they price in negative news. They don't like uncertainty. And as things become more certain, I think you can start mapping out a roadmap to the economic recovery, the market recovery, and Americans getting back to that way of life.
Yeah, agree. Many companies I want to talk about here. We're going to go through them pretty quick because we're at the back end of our show. Zoom, a little bull flag up here, Matt. Interesting chart. Been a top performer. What you read?
Forming a little bit of a bold flag. I still don't believe anything can be swing traded to the bullish side. But Zoom's one of those companies that has obviously had a tremendous amount of demand come into it over the course of the last month. But really, even before the situation started coming out into the public conscious, you started seeing Zoom start to price appreciate coming into January and early February. A company that should be on everybody's radar for, in my opinion, the very, very long term, because I do believe you will see some shift in consumer behavior from a corporate behavior perspective, with more companies, more schools, more just society utilizing products like Zoom and other online hosting centers as well. So maybe you don't chase the dragon, maybe you let it kind of settle down a little bit, but I would keep Zoom on that time horizon for the future. Also, Tim, Slack came out, WORK. They came out today with some fairly positive numbers on their subscriber growth, and they're testing a potential breakout of that significant whole number right there around 30. Obviously, a little bit overextended, but keep an eye on Slack as it behaves north of that 30 number.
Matt, what is Naked Puts trading for on Slack right now?
On Slack,
what are some of those April puts?
I really like Slack because I think the number of things that are sent through email that don't need to be emails, Slack is taking care of that. Being able to have a quick message center amongst multiple departments in a company is awesome.
Mark, you get $45 on 213 margin for the 22-day contract at 21.
I mean, Slack fits the model. like moving forward, I'm just always looking to get something cheaper.
Mhm.
And it's a company I really like. I think it's fundamentally shifting the way corporations kind of, communicate within a corporate atmosphere. Also, Tim, Micron MU reports earnings here today. Now, again, these early earnings reports, they're not exactly reflective of everything that's been transpiring here, but Micron did report 45 cents earnings per share versus the expectation of 37 cents. They came in line with their revenues at 4.8 versus 4.7. A little bit of a muted response to that, showing a little bit of weakness on that intraday. It's going to be interesting if how Micron behaves around that $50 mark, maybe around that 200-day moving average. Also, Apple announces here today that they are considering a delay on their next iPhone release, which is typically slated for September or October. So that was interesting news. We already talked about United Health introducing the Corona self-test, and Beyond Meat got downgraded. I guess we're not willing to pay a markup in a pandemic.
We are not.
I'm telling you, Mark,
what was really funny,
my
Matt?
family is largely a vegetarian family.
Mhm.
The only meat eaters in my family are me and my son, Tanya. My wife, my 3 girls, all vegetarians. Okay. And when I went to the store about a week ago, there was no meat, but you could buy as much vegetarian stuff as you could.
I was just about to say that. I saw the same thing here. It was like Beyond section was like filled up still. Meat's gone. It was like, all right.
That's
We
Even
will
in a
work-
recession, people don't want to eat it.
We will worry. Yes. I mean, but it makes sense, right? Like, when people's fear is high, they, idealism goes out the door, and yeah, makes sense.
Yeah.
Plus the company sucks and they don't make any money.
By the way, I'll tell you
So-
the meat that's always off the shelf in my grocery store is chicken. You cannot find chicken in the store I shop at. It's just the second it's put up there, it's gone immediately. You can find some beef and some other stuff and whatnot. I'm sure they'll restock those Tyson chicken TSN. But Matt, they might not be buying Beyond Meat, but they are buying chicken breast. There's no doubt about it.
No doubt.
Yeah.
No
All right.
doubt.
One
all
other
I got.
company, Walmart actually suspended the rents for their little vendors. Like if you go and get your hair cut at Walmart and all that kind of stuff, the eyeglass shops, those people pay Walmart rent to be there. They said for 1 month, no rent. Amazon actually stopped the loan payments on their biggest buyers as well, the people who do a lot of business on Amazon. If you borrow from Amazon and use like credit funding and whatnot, they said that we're not going to make you pay that in April as well. Oxy was a junk bond rating as well. I still got to wrap my head around all these junk bond ratings, Mark. I think it's fascinating. And one of Mark's old favorites, Micron, upgraded. So Micron, chip maker Mark, upgraded today.
Upgraded in front of earnings.
Do not like that chart, but we'll see how that one shakes itself out. Very, very good job here today. A lot of deep thoughts and a lot of conversations, a lot of discussions. We're still trying to process what's happening in the price. But while you're in a trading day, focus on the price. One last look at the S&P, by the way. We're sitting up near the high, 2567. Matt, we going to push 2600 today, you think? Or you think we're going to see a sell-off?
I'll let you know 20 minutes before the close. I
I'll
think
tell you
anything
after
other
that.
than that is a pure guess.
I mean, that's looking like a little head and shoulders forming. We just need that right shoulder.
Yeah, high base up here. Yeah, there's no doubt about it.
It's basing. I mean, it's fascinating to see a high base on a 5-minute chart that has a 1% range. That is fascinating.
Mm-hmm. Yep. All right. Great job, guys. We will be back tomorrow. If you're watching our channel for the first time, always subscribe, click the bell, come join us each and every day. If you're a member of our pro community at Tackle Trading, as always, let us know if there's any way we can help you. Buzz us an email, team@tackletrading.com. And if you're looking to join our community, there's a 15-day trial link in the comments below. We're out. We'll see you guys tomorrow.